The crux of which, speaking, of course, of your note, is that now we've spent 61 days and counting below the 50-day moving average of the S&P 500. So take that into consideration before you get all bulled up on a couple of days' moves.
Yeah, thanks. Good to be here, Scott. Yeah, that's right. So we went back and looked over 50 years of market history, and getting 60 consecutive days below the 50-day is pretty unusual, as you might have guessed. The last time we saw that was November 2008. And really, if you look at the prior samples throughout time, the majority of them tend to occur in established bear markets. Again, not surprising. But the crux really is that it rarely when you're at 60 days, rarely did it mark the end of that bear market. November 2008 obviously was towards the tail end, but you still had that last 3-month drop into March '09 lows. And so ultimately, we're kind of in this what we call a messy period of time where people are trying to figure out, is it the bottom, is it not? But ultimately, we don't think we're quite there yet. And so we think rallies, up towards 4,000 should be selling opportunities in anticipation of that final leg lower that we think ultimately gets to sub 3,500.
Why? What takes you there?
Well, I mean, if you look across the market landscape, obviously, you could make a case that, wouldn't take much from some of the top 5 tech names, Apple, Google, Microsoft, wouldn't take much, just the way the market mechanics are. But ultimately, we saw a lot of headlines today about how positioning and sentiment is the most bearish since '08. Again, remember, October 2008, while that was a great buying opportunity if your time frame was longer than 9 months, there's some pretty significant damage. There's about 40% downside from October '08 into '09. And ultimately, while we've seen positioning and certainly sentiment surveys get very bearish, we never saw some of the signals that we have seen at every major market bottom over the last 15 years, something like the VIX curve, right? We've never seen a market bottom where you didn't get at least a 10-point inversion in the VIX curve. We just haven't seen that yet. So that's just one of the reasons we're looking for.
Anastasia, you have a question for Jonathan?
I do. I mean, I get it that we've been stuck below the 50-day moving average for a while now, but at the same time, look at the S&P today, looking at 3922, which is the 50-day moving average. We're not that far away from it. So my question to you, Jonathan, if it does get to that level, if we cross above it and manage to stay above it, what happens then? How much CTA volume might come into the market? Is that going to drive us higher technically? And can they kind of offset some of the fundamental headwinds that we have?
Yeah, so remember, moving averages are just a way to gauge trend. And the longer the moving average, the longer trend you're talking about. So a 50-day moving average we would call medium term. So certainly if you can get above that and get that moving average to start to flatten out and ultimately turn higher, that would be a good gauge for the medium term trend. The issue is that, the really important moving average for most participants in their trend is that 200-day moving average, which is still well above us, still firmly downsloping. So we're open to the fact, to the potential for a rally back towards 4,000, 4,100. We just don't think that rally in itself will change the primary trend. So again, could we be at some sort of market turn? Of course.